Okay, let me ask you this. How does an economy grow at nearly 13% in a global climate where most countries would kill for 3%? That's exactly what Taiwan's doing right now. And no, it's not some statistical fluke. This is real, shocking growth that's been blowing past every economist's prediction for 3 straight quarters. But here's what fascinates me most: this isn't just about chips and tech. There's a deeper story here about how one island became the ultimate proxy bet on humanity's AI obsession. Let's unpack the numbers first. Second quarter GDP clocked in at 12.92%, which sounds insane until you realize it's actually a slowdown from 14.55% earlier. Even there, moderation would make most economies jealous. But what really caught my eye? Domestic demand outpaced exports as the main growth engine. In a country that's basically the global semiconductor factory, this feels counterintuitive. Why is local spending suddenly surging? The answer might lie in what I call the stock market halo effect, when rising asset prices make people feel wealthier and spend more freely. Turns out, Taiwan's equity rally earlier this year didn't just benefit tech companies, it trickled down to consumers splurging on travel, gadgets, and services. That outbound tourism boom isn't just vacation selfies, it's data showing middle-class confidence. Now let's address the elephant in the room: how much longer can this AI-driven capital spending spree last? We're seeing cracks in the tech sector globally, with major sell-offs in semiconductor stocks. But here's my take: Taiwan's situation is different. Their growth isn't speculative hype, it's physical infrastructure being built right now. The factories humming with ASML machines and TSMC's 3nm fabs aren't just responding to today's AI demand, they are enabling tomorrow's breakthroughs. This isn't a bubble, it's the foundation of the next industrial revolution. And that distinction matters. But wait, should we be worried about those export numbers? Exports grew 47% year-on-year while imports surged 40%. Some might call this a dangerous imbalance, but I see it differently. This isn't reckless spending, it's strategic repositioning. Those imports? They are mostly advanced machinery and energy inputs that'll compound future productivity. It's like watching a chess master sacrifice pawns to control the center board, short-term costs for long-term dominance. The big question everyone's dancing around: when does this party end? Fourth quarter base effects will definitely create headwinds, but let's not forget, Taiwanese policymakers aren't asleep. A potential 0.125% rate hike seems almost comically small compared to the scale of this growth. Honestly, I think the central bank's biggest challenge isn't slowing the economy down, but avoiding overheating while maintaining innovation momentum. And here's a contrarian thought: maybe all the forecast revisions we're seeing, from 10.1% to 11.1% GDP growth, are still too conservative. We're not just watching linear progress, we're witnessing an exponential curve in semiconductor capabilities that Taiwan sits directly atop. So let me leave you with this: Taiwan's story isn't just about economic statistics, it's a case study in how geographic concentration of expertise creates asymmetric advantages in the AI age. When historians look back at this period, they might see Taiwan not just as an economic miracle, but as the literal crossroads where humanity accelerated its machine intelligence journey. What do you think? Does this signal a permanent shift in global economic power dynamics, or are we all just getting swept up in the last great hardware cycle? Let's debate it in the comments.